everyone, welcome back to the HFAC comp. In the last video, we introduced accounting and started off with our first financial statement, the income statement. Now, the income statement tracks the amount of money a company brings in, or its revenue, over a certain period of time, like a quarter or a year. And then in the income statement, we can also see how some of the expenses of a company look, such as the cost of goods sold, the actual materials that go into making product and getting that revenue, and also operating expenses, such as selling, general, administrative, the marketing expenses, R&D, research and development, depreciation and amortization, and we also get a look at interest payments and taxes. Now, we want to move on to our second financial statement for this video, which is the balance sheet. Next week, we'll go over the cash flow statement, which will be our final financial statement. So the balance sheet is a statement that effectively shows a snapshot of the current assets, liabilities, and book equity of a company. So what does that mean? The balance sheet measures stock variable. It tells the value and kinds of assets and liabilities that are owned at a given point of time. And there are three big sections to describe what a company owns, which are assets, liabilities, and equity. Now, if there's only one thing you take away from this video, that's going to be the key accounting identity here, which is that assets equals liabilities plus equity. Now, we're going to go through in each one of these three categories and look at some of the individual line items here. So let's start with assets. What are assets? Assets should be pretty basic. It's the stuff that a company owns. More precisely, the traditional definition is resources that bring future economic benefit, either through the prospect of future cash inflows or the prevention of future cash outflows. So what does that mean? It means that something that can generate money or something that prevents you from losing money. And there are two conditions that we have for something to be an asset. The company must legally own the asset, and there must be an expected future benefit that is both probable and measurable. So a stapler that's sitting in a company's headquarters probably is not going to be considered an asset because it's very hard to measure an expected future benefit. But a machine that is generating product that is getting sold out is definitely an asset because there's an expected future benefit and we can measure how much benefit that machine gives us. So on our assets, we have a few line items. First, our current assets, which include cash, accounts receivable, inventory, and prepaid expenses. Next is PP&E, which stands for plant, property, and equipment. And the last one is goodwill. So let's go into these in a little more depth. First, we have cash. So this is just paper or electronic money that can be spent immediately. Sometimes you will see cash and short-term equivalents, which might be certain types of T-bills or treasury bonds that are very liquid and can be very easily moved into cash. Next is accounts receivable, money owned to a company by its debtors or usually customers. So when you go to the Apple store and buy an iPhone on a credit card, Apple doesn't get the money directly from American Express or your credit card company. It normally takes anywhere from 60 to 90 days. So Apple, if they want to generate a balance sheet after you've made your purchase, can mark it under accounts receivable because that money is owed to them by the credit card company. Next is inventory, which is the finished merchandise or also the raw materials that a company has on hand. Again, these are things they've already paid for. And then prepaid expenses, future expenses that have been paid in advance. Maybe you purchased a legal firm and you paid them a retainer, or you have some other expense that you've already paid for, like a subscription cost or something like that. So maybe you have a yearly subscription, you pay it all up front instead of paying it monthly. Now, we call these current assets, and current assets are very simple. It just means that you're going to use the asset within 1 year. So you'll also see current debts, which means the debt is coming due in 1 year, and we'll get to that in a moment. But current means within 1 year, long-term means greater than 1 year. Anytime you see current, think less than 1 year. Anytime you see long-term, think greater than 1 year. So now long-term assets are now plant, property, and equipment, which are, again, very straightforward. The plants, your property, and your equipment. So these are the items that are expected to be used over a very long time and are used in production, rental, distribution, and administration of your business. So again, this could be the machines that make iPhones, this could be the factories, this could be Apple's new spaceship headquarters. This is all plant, property, and equipment that will go there. And then lastly, we have goodwill. This is a little more specialized, but this arises when one business acquires another. This is equal to the acquisition price paid minus the fair market value of the business. So you might have an auditor come in and value what the business should be. And then if you paid more than that, that's going to be marked on goodwill because there's obviously some asset there. And we'll talk a little bit about what fair market value is towards the end here. So this is assets. Very straightforward. Again, the descriptions are all here, and you're going to cover them in a little more depth in the section. Next is liabilities, which is also pretty simple. The stuff that a company owes to others. You can have personal liabilities if you have credit card debt or something. You owe that money to someone else. And more precisely, again, a probable future economic sacrifice resulting from a current or past event. Now again, just like we have conditions for something to be an asset, we have conditions for something to be a liability. First, the economic sacrifice is probable, so it's likely you are going to actually have to owe that money to someone else. The amount of obligation can be quantified. We know exactly how much money we owe, and the event leading to that obligation has occurred. So if you were taking out a loan of some sort, you've already signed the loan documents to take out the loan. So again, liabilities, we can mark it with current liabilities and long-term debt. Accounts payable, deferred revenue, and the current portion of long-term debt are all considered current liabilities. And then you have long-term debt and capital leases. So let's delve into those for a second here. So again, our definition of current and long-term is the same. Current is used or paid off within 1 year. Long-term is greater than 1 year. So anytime you see that in any financial context, you can immediately think 1 year or greater than 1 year. So accounts payable, very similar to how we have accounts receivable. Accounts payable is money owed to a supplier for goods or services purchased on credit. So maybe you go ahead and buy an iPhone from Apple on your credit card. So Apple might book the $500 or whatever as an accounts receivable on their end as an asset. But American Express now has to move that money to Apple. So American Express will mark it as an accounts payable on their balance sheet. That's a pretty good example there. So that's accounts payable. That's just money you owe to someone else that you've already received, and then you just have to actually go and make that payment. Maybe your billing department is a few weeks behind, and they actually have to go and make that payment out. Next is deferred revenue, cash received for goods or services that have not yet been delivered or rendered. So maybe you have pre-release or like pre-orders of something. So iPhones just went on pre-order today. So if you went ahead and pre-ordered it, Apple can mark that as deferred revenue because they have yet to actually deliver that product to you. So it's still sitting under the inventory side of their balance sheet. Next, you have short-term debt which is a maturity in 1 year or less. You can have a revolver or a line of credit, which is just like a credit card for corporations. You can have like $1 million revolver. So if you need to draw on that credit line, you can do so. That's used for short-term expenses. And then next, this concept of long-term debt. So these could be bonds that a company issues. This could be long-term debt that might be 5, 10, 15, 20, 30-year maturities. And we'll break it up to the current portion and the long-term portion. So the current portion of this is going to be the part that's due in 1 year or less. Then you're going to take the remainder of it that's due after 1 year, and that's going to be the long-term debt, which is a long-term asset. And lastly, you can have also capital leases, which is the value of all future lease payments for a given lease. So if you sign a contract for a 2-year lease, you have to mark down that you actually owe that money to someone else because, again, you're in a contractual obligation to pay out the remainder of your lease. So we mark that on a capital leases on the liability side on our balance sheet here. So these are, again, the liabilities. The definitions are all here, and you're going to go into them in a little more depth in section. The next key category is equity, and this can be a little confusing. So equity, remember our accounting identity says that assets is equal to liabilities plus equity. So what is liability? What is equity? If we just flip that equation around a little bit, that's the same thing as assets minus liabilities is equal to equity. And equity is the residual value of the business after liabilities have been fully paid off. For corporations, we often call this as shareholders' equity or book value. And we'll talk about book value and market value in a moment here. But equity, we normally see it in two main forms, which is paid in capital and retained earnings. But remember, the definition of equity is whatever is left effectively after you do assets minus liabilities. Now, on our balance sheet, we're going to mark a certain amount of equity. But the question is this equity the same that is sold to shareholders on the open market? So is the value of the equity on the balance sheet the same as the value of the business's stocks or shares? Because we take pieces of the business as split it up into millions of pieces, and that's an individual stock, so you own a little bit of that equity there. So is this the same that's on the balance sheet as the value of the business stocks and shares? So now would be a good time to pause the video and think about this for yourself. So welcome back. So the answer to this is no. And the reason is when we have assets and liabilities, we record them on the balance sheet at their fair market value. So this term fair market value came up when we talked about goodwill. So This is literally how much you can go and take the assets, the property, and sell it for on the open market. That's fair market value. When a business becomes more or less attractive, the financial markets will either bid up or down the value of a publicly traded share in the business. But the equity on the balance sheet will be unchanged. This, remember, goes back to our first discussion in our kickoff when we talked about how investing is about expectations. So the market expects future cash flows from this company, so they are going to increase the price of the equity on it because they believe in the long run you're going to receive a payout every quarter, every year of some certain cash flow. So we only change the equity on a balance sheet when a company issues new shares, retires or buys back existing shares, or 3, generates new earnings. So these are the only 3 cases when the equity on a balance sheet is going to change. Now, let's just go and delve into the 2 key aspects that we saw on our balance sheet template a moment ago, which were paid in capital and retained earnings. So paid in capital is the value of funds that shareholders have invested through direct purchase of stock in the company. So this could be you going to the New York Stock Exchange and buying stock in Apple, or this might be someone like a venture capital firm buying private capital in a startup or something. They will also have a balance sheet just like this. Now, we normally think about stock in 2 forms. We think about common and preferred stock. So common stock is the simplest and most basic form of equity ownership in a business. Common stockholders are paid last in the capital structure. So what does that mean? If a company goes bankrupt, as an equity holder, you technically aren't entitled to anything. But if you, again, take all the assets, you cover all the liabilities, and there's anything left over, equity holders will receive some sort of payout, or are supposed to receive some sort of payout. But now, when you're in an equity holder, your preferred equity holders, your preferred stockholders, are going to receive payment first, and then your common stockholders will receive payment. So preferred stock owners are a higher class of equity ownership. They might be the same value in theory, like you might own the same fraction of a company, but those stock carries a little more weight. It weighs a little higher on the capital structure there. And then another key point with preferred stock is it can also sometimes have more voting privileges or board rights, etc. So a lot of founders will take on special preferred stock, which gives them a lot of voting rights in their company. Lastly, we can also have additional paid-in capital, which is the excess over the par value of a share paid by investors. This can rise from issuing either preferred or common stock, usually during an initial public offering. So you issue par value, right? So a company will go out to open markets and say, we believe our stock is worth $7, but when it actually starts trading a few hours later in the market, that maybe is trading for $10. So all that excess spread that's been captured will go into additional paid-in capital. Lastly, we have retained earnings. So remember, on our income statement, we saw net income. Now that net income is going to flow into retained earnings onto our balance sheet. So this is the accrued net income. So every year you make a little bit of net income, you add that to your balance sheet, and it slowly builds up over time, generated in previous years by the company. So when you say that the equity holders in a company will take the profits, this is exactly how they do so. It goes into the retained earnings, and that builds up the equity portion there. Now, key thing to remember about the balance sheet here. Remember, it is a snapshot. A income statement or a cash flow statement are looking at something over a period of time. So we're saying, how much revenue did you bring in 1 quarter, 1 month, 1 week, 1 year? A balance sheet is just saying snapshot of what is the company's balance sheet. What are the assets at this time? What are the assets? What are the liabilities at this time? What is the equity, the book equity looking like at this time? So it's just a snapshot at a given point in time. So that's a very key thing to remember. The other ones measure a flow. This one is a snapshot. So overall, we've talked about the balance sheet. We've talked about the 3 key parts here: assets, liabilities, and equity. And remember, if there's only one key thing that you take away from this video, that's going to be that assets is equal to liabilities plus equity. Remember, this is one of the most important accounting identities. In section this week, you're going to go over the different categories a little more specifically, and you're going to look at some real-life balance sheets from Lululemon and some other companies on the SEC website. And next week, we're going to talk about the cash flow statement, and that's going to be our last financial statement. And the week after that, we're going to spend some time going over some exercises and trying to connect all our statements together. We already saw that today about how net income from the income statement flows into retained earnings on the balance sheet, but things get a lot more cooler when we throw in the cash flow statement. So we'll see you next week. And